Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His website's pifinancial.com and polarfuturesgroup.com. Welcome back to the show, Drew.
Thanks for having me on, Jim.
Drew, it's hard to believe it's been a month since the last time we talked about what was going on in the markets. What stands out for you in the past month?
Yeah, I mean, it feels like it's been 3 months since we've spoken, but it's just because there's been so much going on, such big moves in the market. We continue to see price swings. I mean, last time we were talking, we just witnessed for the first time ever negative crude oil prices. That was a huge development. So we just went through the next delivery months at the start of this week, and so many people had been looking for or expecting the possibility that we could see the June contract as it went for delivery, that it would also go negative and really upset the oil market. So, you know, as much as there's been a lot of choppiness in markets, I think there's also just been a tremendous amount of stabilization or consolidation or whatever you want to call it in the last month. I mean, we can look at the S&P and say, you know, hey, we're, you know, breaking out to multi-month highs right now. But if you go back to where we were in April, on April 20th, a month ago today, you know, we weren't really that much higher, or we weren't that much lower from where we are right now. So it has been a very choppy period. I think that's just been a big impact of, you know, what the Fed was trying to accomplish. And I mean, you could say, you know, maybe they've done too much because the NASDAQ is, you know, 40% off the lows and they're just goosing financial assets again. But I think their main goal has been to stabilize markets, to make sure that they function. And I think if you look at the last month of markets, while they've been choppy, as I've been saying, you know, they've largely stabilized. And, you know, yes, we are at the high end of that range today, but, you know, do we stay here? I'm not sure. But again, you've had a Fed that, you know, did whatever was necessary, and not just the Fed, the ECB, the Bank of China, the Bank of Japan, the Bank of England. You know, they've all come out in a coordinated effort to stabilize markets. So if you take a step back and you can see that that's worked, you know, oil prices have more than stabilized. They've come up dramatically, but again, I think you could say that was from exceptionally low levels, given a market that really broke down when crude oil prices went negative. I think that was a mistake of the exchange. So the fact that, you know, the front month, the July contract of crude oil has almost doubled off the $18 lows is, you know, maybe an outside sort of event. But again, the crude oil market did spend several weeks in the last month stabilizing. So as much as you can point to different markets being at multi-month highs or you know, bonds, the interest rates staying near their lows, that sort of thing, I think the big thing to take a look back at is we really have stabilized a lot of markets over the last month. And I think that's, you know, everybody says, you know, don't fight the Fed with equities, continuing to be strong. But at the same time, you know, their mandate was to try and make sure things work and stay stable. And I think they've accomplished that to some degree. So maybe the biggest takeaway in the last month has been try and take a step back from the chop and realize, you know, that the Fed has stabilized things. And we've had a consolidation period for a month. A lot of markets are near the higher end of their bounce back levels or that consolidation range. And now it's a good time to sort of decide where we think things will go from here.
Mm-hmm. Now, of course, we're still getting every once in a while a 400-point or an 800-point bounce. And people now shrug. Remember when we used to panic? Oh, my God, the market went up 800. It went down 800. Now you go, well, that was just today. Well, there isn't the same feeling of panic or distress that it caused when this initially started.
Yeah, you're absolutely right. And that is, something that I think comes to human nature. The old, you can boil a frog as long as you put them in the warm water and slowly turn it up. We get acclimatized to a lot. And I think it's helped the market that some of the bigger moves in the last month have been to the upside. We have had some sharp sell-offs. Even yesterday afternoon, but, as you were saying, the Dow, up 1,000 points on Monday as it was sort of getting good news all over the place. So still a lot of volatility, still a lot of choppiness. And I think that's again where it's important to take a look back, step back in your charts and look at some of the dailies or weeklies and go, okay, what's really happening? We're just really trying to shuffle through a lot of, good news, bad news, good news, bad news, and in that time period, we really haven't gone all that far. It's been a big, choppy sort of consolidation block. And at the end of these time periods, a lot of the time you either get a breakout to the upside or, at this case being at the upside, either we go back down towards the low end of this consolidation range and break down, or we just stay in this range for an extended period. And I would almost argue that you've got the central banks pushing or driving to keep this stabilization range or this consolidation period going as long as possible. So, we've seen in the last several weeks, the Fed pulling back their weekly bond purchases. They're doing that sort of quietly and gradually, but they are slowly stepping back on the amount of purchases they're doing. They still have a lot of other programs running, but if they can step back and allow the market to stay at these higher levels on its own, that's good for them. They've got more firepower for, if we really run into some issues and start selling off again.
We'll have more with Drew Zimmerman right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Drew Zimmerman. Drew, with equity markets reaching new weekly highs, do you think this momentum has a good chance of continuing?
Yeah. Just to continue on from our discussion of this being a big stabilization period that's been very choppy over the last month, I just continue to get the sense that, again, the equity market is is maybe the best barometer of investor sentiment. And that's going to be driven a lot more by emotions than, everybody going in and doing their balance sheet math and trying to figure out what each company is worth and therefore, what the entire indice is worth. It tends, I think, especially in these types of scenarios, to trade emotionally on headlines, and you're going to get wider swings in each direction. So with that, the sort of metaphor I've been using with my clients is when the market is in a bullish frame of mind, investors are willing to, take in the good news that comes along, but are less willing to accept some of the bad news that comes along with it. But my metaphor for that is if you're sitting at your desk and you get, a bad letter or a bad piece of mail or bad note, you look at it, and if you're in a bullish frame of mind, you just go, okay, it doesn't matter. I'll put it on the corner of my desk. And then you get another one, retail sales in the U.S., absolutely terrible. Okay, I'll put that on the corner of the desk. GDP estimates continuing to be awful. We'll put that on the desk. New PMI numbers, industrial PMI numbers still terrible. Well, you put that on the side. So the markets, when it's in a bullish frame of mind, is really willing to ignore or look through or look past a lot of these bad economic events that are coming up, and you can, rationalize away to say that, a lot of that data is stale, we're forward looking and all that sort of thing. But I do think there comes a time where all of a sudden we get something that starts to change the sentiment of the market. And, maybe it is just the upside exhaustion. I mean, the NASDAQ up over 40% off the March 23rd lows. And that's when investors can turn and look at the corner of their desk, and you start to realize the bad news that you've been overlooking for the last month and start to see that pile has actually gotten quite large, and all of those stories or notes become that much more important again. So it can just be the smallest thing that changes that initial sentiment, but then it can really change things. So if that metaphor explains itself clearly, I think that tells you that I do think we are running into some exhaustion on the upside of equities. I think the fact that, we have consolidated over the last month, well, pushing to, slightly new highs in the S&P and the Dow, obviously the NASDAQ being a much stronger story. But I do think we still are seeing a lot of bad news stories piling up on the economic front. And I think even as we start to go through this reopening process that has been bullish for equities, it's been a hope of what can come that might not get lived up to in the coming weeks and coming months. So I think that the market may have to start pricing that in, that even though we are able to open up our economies some more, the revenues aren't going to be there. People won't go back to their old ways, quickly enough. They won't be spending enough money. Now the consumer is in relatively good shape in both Canada and the United States and globally. I mean, the fiscal side of the government has done a lot to protect consumers from this event, saying, it hasn't been anybody's fault. Therefore, you shouldn't have to default on any payments because we're telling you to stay home. So that's really held up, consumer sentiment, consumer expectations. Delinquencies aren't, extreme by any means. But I wonder if as we start to open up and people go back to work, and that is, the people that are willing to go back to work, because there are some people that are in a much different mindset about this still and less willing to go back to work, especially if they're at the lower income side of things where they can make just as much, if not more, by staying home. Then does our economy, get back to function? And at that point, have we, used up a lot of the fiscal stimulus that we're willing to throw at this? To use even the outgoing Bank of Canada governor, Stephen Poloz, was saying, a fireman was never blamed for using too much water on a fire. So I think that was the approach of governments everywhere as we first locked down, was let's just throw everything we have and then some at this as far as stimulus, get it into the hands of everybody as fast as possible, and we'll deal with everything else later. I wonder if that frame of mind isn't overextended. We're seeing that now with the Democrats trying to push through another $3 trillion in stimulus, and a lot of the Republicans in the White House saying, no, we're not ready for that yet. Even Mnuchin, when he was testifying to the Senate the other day, sort of willing to be in more of a wait and see mode. And if that's the case, then maybe we start to see some of the economic hardships that we've sort of put a Band-Aid on for the first few months of this lockdown start to get pulled off as the economies open back up, but again, at a much lower rate than they have been operating at before COVID. So that's my worry. I think the economic data that we're seeing is still terrible, and while we will see some bounce back, we're not going to be bouncing back to anywhere near the levels where we were pre-COVID. And I think that's where, we have to look at where we're pricing some of the risk assets, especially, we look at the equity market very easily and say, have we gotten ahead of ourselves in where the risk asset prices are? And I think yes. So I'm looking at this being extended, but at the same time, I've thought that for the last couple of weeks, so I will call myself out on that for being early and for this rally just having a lot more buying power to continue to hold it up. It's been, again, just to new highs. It continues to trade in a bit of a range here, but the fact that we really haven't had any significant downside over the last several weeks has surprised me. I thought we would see more price rollover as we've sort of gone through this opening process. But again, here we are at all-time highs, so I think there's still some bad news that needs to be digested. But as it stands right now, investors are willing to maintain that bullish mindset and, in my mind, keep that stack of sort of bad news on the corner of their desk growing.
We'll have more with Drew Zimmerman right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, what's your view on the Canadian dollar, considering it's usually viewed as a commodity currency?
Yeah, the Canadian dollar, especially with the fluctuations that we've seen over the last several months in crude oil and the importance of crude oil to the Canadian economy, has been a very interesting trade as well. Obviously got sort of really sold off hard in the depth of the stock market sell-off into the end of March, but has also, bounced back and really in the last month, been in sort of a 1 to 1.5 cent range, 72 cents where we are now on the high side, 70.5 to 71 cents on the low side, and just, chopping back and forth with the ebb and flow of the risk on, risk off sentiment. And, normally we've seen maybe stronger correlations with crude oil and the Canadian dollar than in the past. I think part of that is the fact that, the crude oil market is also having a big impact on the U.S. economy. It's a huge part of their economy now as well. So maybe that U.S.-Canada cross rate is less impacted because both economies are going to be impacted by crude oil. So that relative difference there has gone down. But for me, the currency markets, in the most simple way are a function of risk on and risk off. And I think, again, you can tie that back to the sentiment of the equity market and of the S&P. So if you're going to see the S&P having a strong day, the Canadian dollar will likely do better. And again, with Canada coming back up to the 72 cent level, again, on a very strong day on Monday as equities did better, stronger today as equities have done better again, But again, coming back to what seems to have been fairly strong resistance over the last couple of months, I still think Canada was on a soft footing economically coming into the COVID issue. We were seeing a lot of our economic numbers slow down beforehand, similar to Germany, where, Germany was in a manufacturing recession before COVID started. So I think that makes it that much harder for the economy to come back. And again, even if we came back to pre-COVID levels, I think we're coming back to an economy that was slowing at that time as well. So I do think the Canadian economy has got more struggles ahead. I think that even with the front month of crude getting, up into the mid-30s, helps Canada. Again, if crude oil were to fall off again into the 20 handle on the front end, that really isn't good for the Canadian energy industry. We're still struggling, for years with the Canadian energy industry. We've now heard that Biden wants to revoke any of the approvals for the Keystone XL. Should he get elected, that will be an interesting talking point as we go into the U.S. elections. And that would really be a detriment to the Canadian economy. So I would like to think, it's more Canadian economy specific. But when you look at the trade action of what we've seen over the last month, it really is all about investor sentiment. And if we're willing to take on some more risk, people are willing to buy into the Canadian dollar, the Canadian economic story. We see the Canadian dollar do better. And as things soften off, the Canadian dollar sells off. So much like the equity market, even though we've stabilized over the last month, I think the 72-cent level is likely to remain a fairly significant resistance point. And if we start to look at and or price in some of the negative economic news that we have coming forward and have maybe a little less hope going forward because we've already priced a lot of that in, I think the Canadian dollar could move much lower. I think we could see Canada, retest the lows in March. And I think that could happen even without the equity market getting anywhere near those lows. I just think that the relative U.S.-Canada performance will go to the U.S. side. Again, I think there was some struggles in Canada before we got into COVID, and I think those are going to remain in place. So I think the 72-cent level we're at now is going to remain a resistance point. Maybe we break above that short term just to really, hurt any traders that thought they'd be smart enough to put a stop just on the other side of that. But again, my near-term view is we've got a lot of the good news priced in. We could see some more bad news come in a couple of weeks that would see the Canadian dollar head back lower.
Drew, thank you so much for chatting with us.
Thanks for having me on today, Jim.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. Check out his websites, pifinancial.com and polarfuturesgroup.com. If you have any questions for Drew or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.